So here are 4 loan types that you can use to buy a house with less than 3.5% down. I'm going to go over FHA loan, conventional loan, VA, and USDA. And if you don't know who I am, my name is Meredith Silk. I'm the owner of Silk Mortgage. I've helped hundreds finance real estate, and I'm on a mission to make the mortgage process smooth and simple while offering the best rate guaranteed. So let's get into it. Okay, so number 1 is the FHA loan. And FHA loan, it's a government loan that's backed by the Federal Housing Administration, and it's for buying primary residence only. The minimum down payment is 3.5% down, and this loan is really geared towards those with a lower credit score. So the minimum credit score is a 580, and I'm just going to be honest with you, if you have a 580 score, you're going to get killed on interest rates. So do what you can now to bring up your score to at least a 620. It's going to make a huge difference in rate. And it's, generally speaking, easier to qualify because it has a higher debt to income ratio. Now, some of the pros are you can buy a house with a low credit score, and they have a higher debt to income ratio, so you can borrow a little bit more than if you went with the other loan types. Some of the cons, there's really 2 cons. Number 1 is going to be the mortgage insurance. So you're paying for the mortgage insurance in 2 ways. Number 1, there is an upfront fee that's financed into the loan. It's 1.75% of the loan amount. And 2, you're going to be paying a monthly mortgage insurance that's included in your monthly payment. It's for the lifetime of the loan. It never drops off, even if you pay down the loan. And number 2 is they're really strict on the condition of the property. So the property really needs to be in moderate and good condition. It can't have any active roof leaks. It can't have any wood rot, any structural issues. And if it does, then the seller would be required to repair those issues before closing. And that's why it's a less competitive loan when it comes to how the sellers view it. So number 2 is the conventional loan, and with this type of loan, the minimum down payment is 3%, and that is if you're a first-time home buyer and buying your primary residence. Typically speaking, and you need a little bit of a higher credit score to qualify for this loan. It's normally around 680 plus, and the mortgage insurance, it will automatically drop off of the loan once the balance drops below 78%, and it automatically does it. You don't have to do a thing, and that's one of the biggest pros on this type of loan. Another pro is if you're buying a house that needs a lot of TLC and repairs, this is going to be the only loan product that will work for that house, because you could have a active roof leak, you could have structural issues. As long as there's not any potential major safety concerns, it will be fine with this loan. And that's why it's a very competitive loan. When you're in a multiple offer situations, normally sellers will accept a conventional loan over any other type of loan products because it's easier on them. They know they won't have to do a bunch of repairs. Now, one of the cons to this loan is the debt to income ratio. It's capped at 50%, as if with FHA it's a little bit higher. So that's really the only con to this loan. The number 3, VA loan. So this type of loan is for those that are either in active or retired military. If you're retired, you must have been honorably discharged. If you're still in the military, you must be in good standing. And you must work with a VA-approved lender like myself. And what they'll do is they will pull your certificate of eligibility. Now, with this type of loan, it's 0% for the down payment, and there's no mortgage insurance required. And also, the interest rates are usually a little bit better than the other types of loans. One of the biggest things that you must be aware of when using a VA loan is they're very strict on the condition of the property. So the property must be in good condition. There must not have any termite issues, any mold issues, any active roof leaks. If there are, the VA appraisal they will catch that during their inspection, and the seller will have to fix those repairs before the closing. Number 4, USDA loan. So this type of loan, it's a government loan. It's backed by the U.S. Department of Agriculture, and these are for homes in rural areas, and there are county eligibility, so you must look that up before to make sure that your home falls within the limits. It's also 0% for a down payment, and the reason is they're wanting to encourage people to move outside the city limits and develop these areas. Now, there are income limits, so you must look them up online. Look at your county income limits to see if you qualify. Some of the pros are it's 0% for a down payment, and also the interest rate is a little bit more competitive. It's a little bit lower than other loan types. Some of the cons are it is hard to qualify for. So you need at least 640 credit score, and the biggest thing is they're really strict on their debt to income ratios. So if you get qualified for a USDA loan and an FHA loan, your pre-approval amount will be higher on an FHA loan than a USDA loan because of the debt to income ratios are a lot different. They're a lot more strict on this one. And that's why a lot of people end up not using a USDA loan, because it's great in theory, but with how much home prices have increased, it's hard for people to qualify for this type of loan. Number 2 is the mortgage insurance. Just like FHA, you have mortgage insurance that you pay for in 2 ways. Number 1, it's upfront financed into the loan. This one, it's 1% of the loan amount. And 2, you're also paying for it monthly. It stays for the life of the loan, regardless if you pay down the loan amount or not. If you're wanting to buy a house, it's important to start the planning process now. So I hope you found this helpful. Consider subscribing, and I'll see you on the next one.